Welcome to today's market report.
In Europe, with a far more economically sensitive equity market, a vaccine rollout finally closing the gap to the US, and business activity gathering speed, firms from BlackRock are recommending investors boost their exposure to the region. The post-pandemic growth relay has shifted, according to their strategist, from China to the US and now to the Eurozone. With global stocks stabilizing on Friday following a slump, the stock's Europe 600 index jumped 1% compared with 0.5% for S&P 500 futures. As a contrast to the year so far, the US benchmark gained 15% in 2021 through Thursday, while its European peer climbed about 13%. At the same time, a US index or value shares outpaced a rest of world gauge by more than 6 percentage points, according to MSCI indexes. It also means European shares look cheap. Members of the Stoxx 600 trade at less than 17 times expected earnings versus 21 times for stocks in the S&P 500. In the UK, it's even more dramatic. FTSE 100 index companies trade at an average of 13 times the coming year's earning. Eurozone and UK equities still trade at relatively cheap multiples, despite their exposure to both the global recovery and the reflation themes, according to Lombard Odier. These are where we see the greatest likely benefits from economic reopenings, an acceleration in relative earnings momentum, as well as attractive valuations. And while European equity funds drew $16 billion last quarter, the strongest flows in 4 years, they stand to gain even more given $230 billion of outflows over the last 3 years. It helps that the region's economic growth is also likely to accelerate. European Union officials markedly raised their outlook for the euro area economy this week. We see a sizable pickup in activity, helped by accelerating vaccinations, according to BlackRock, who has shifted to overweight on European shares and to neutral on US equities. Valuations remain attractive relative to history, and investor inflows into the region are only just starting to pick up. Of course, the bull case depends on a conviction that economic momentum is only poised to accelerate. There remain fears that new COVID variants can set back the global recovery, which in any case may be constrained by labor shortages and supply bottlenecks, both legacies of the pandemic. Concerns about growth momentum are part of what has stalled the reflation trade in the US. Treasury yields sunk to a 4-month low this week, and a long-short value strategy is done again in July after sliding the most since January 2020, last month. Giant growth shares like Amazon and Apple, the kind Europe doesn't have been back in the ascendancy. Strong EPS momentum should provide further support for global equities in 2H21, but monetary tightening will loom larger into 2022, according to the Citigroup. The UK remains our favorite value trade. The crude oil was traded 2.25% up at $74.58 per barrel. Brent was up 1.97% at $75.57 per barrel. Gold futures was up 0.39% at 1,807.25. On the FX front, the GBP/USD pair continues suffering from downside momentum and trades below the 50, 100 and 200 simple moving averages on the 4-hour chart. Moreover, the relative strength index is above 30, but the pair is not oversold. Bears are in control. It is coming home that chair to England's football team may be at the top of Brits' minds ahead of the final against Italy on Sunday. However, for the GBP/USD pair, it's coming down would be more appropriate. Cable has run up to 138, taking advantage of a dollar breather, but the risen Treasury yields, which is above 1.30%, and the rapidly spreading Delta variant weigh on the sterling. The UK reported an increase of only 0.8% in the GDP in May, half the earlier expectation weigh on the sterling too. Buying pressure in the European currency remains well and sound, and now pushes euro-dollar back to the 118.70 region or 3-day highs. The dollar index was at 92.2.
This is today's market news. Thanks for listening. We'll see you next time.